Have you ever found yourself just staring at a pile of financial reports, earnings calls, wishing someone could just, cut through it all, hand you the absolute core insights?
Yeah, you're definitely not alone there.
In today's world, with so much information flying around, getting to what really matters and understanding it quickly, well, that's key to feeling properly informed.
And that's exactly our mission today. We're doing a deep dive into the latest Q1 FY26 results from Adani Ports and Special Economic Zone, APSEZ for short.
Right.
We've gone through the earnings call, the official releases, the investor decks, basically sifted through it all to bring you the most important bits of knowledge.
Exactly. Forget just the raw numbers for a second. We want to explore the strategy behind them, the growth drivers that maybe surprised people, and what it all means for India's economy, for global trade.
The goal is you walk away feeling really informed with that bigger picture clear in your mind.
Okay, so let's start. The big picture. Q1 FY26 performance, what are the headline numbers?
All right, so APSEs reported a 21% year-on-year revenue growth. That reached 9,126 crore.
Okay, 21%. Solid.
Yep. And EBITDA was up 13% to 5,495 crore. Net profit after tax paid, that grew 7% to 3,311 crore.
7% PD growth. Now, wasn't there something about a dividend timing difference affecting that comparison?
Good point, yes. The Q1 figure last year, FY25, that included a joint venture dividend. This year, that dividend payment shifts to Q2, so it makes the direct 7% PT growth comparison look a bit lower than the underlying operational improvement perhaps suggests.
Got it. So, adjusted for that, the profit growth might look even stronger. But beyond those top-line numbers, what's the real story this quarter? What was surprising or particularly significant?
Well, that's the interesting part, actually. The core story wasn't just about the traditional port operations.
Oh.
The really phenomenal growth came from, well, other areas. The logistics business saw its revenue basically double, 2x growth, hitting 569 crore.
Wow, okay, doubled.
And the marine business revenue surged 2.9 times, almost tripled, reaching 541 crore.
So logistics and marine are really punching above their weight now.
Exactly. And this rapid growth there, it really highlights APSEZ's strategic shift. They keep talking about becoming an integrated transport utility.
Right, moving beyond just loading and unloading ships.
Precisely. It's about broadening their revenue streams, capturing more of the supply chain value. Think end-to-end services. It makes them potentially much stickier with clients compared to just a basic port operator.
That makes sense, that strategic pivot. Okay, besides these internal growth drivers, how are they doing in the market overall, market share? And what about external signals like credit ratings? I saw S&P made a change.
Yeah, good questions. Domestically, their ports handled 6% more cargo volume. That pushed their all-India market share up slightly to 27.8%. It's gaining ground.
Okay.
And externally, that S&P Global rating change was significant. They revised the outlook for APSEZ from negative all the way to positive.
That's quite a jump.
It really is.
Yeah.
They kept the BBB rating, but shifting the outlook to positive is a strong vote of confidence. It signals that S&P sees better credit fundamentals, strong operations, and maybe more stable financial future.
Yeah.
Basically confirms their financial management is working.
That external validation is definitely a strong positive signal. Okay, let's dig a bit deeper then. Beyond the big picture, how did the individual business segments perform? Starting with the core. The ports. How did they fare, both here in India and internationally?
Well, domestically, despite some, let's say, regional challenges, the ports overall showed solid growth. Krishnapatnam Port, for instance, actually handled its highest ever cargo volume in June.
Okay.
Internationally, there were some real standouts. Haifa Port in Israel operated completely unhindered despite the regional situation.
Really?
It delivered its highest ever quarterly revenue and operating profit. Cargo volume there grew 29% year on year, which is pretty remarkable.
Absolutely, given the circumstances.
And then you have the Colombo West International Terminal, CWIT, in Sri Lanka. That just started operations.
Ah, the new one.
Yes. Fully automated deep water port. Huge potential capacity, around 3.2 million TEUs eventually. It already contributed 1.4 million metric tons in its initial phase.
Impressive start.
Plus, Tanzania added 3.5 million tons, and Vizinjam Port here in India, that completed its first year and hit 100% utilization in just its 9th month. Much faster than expected.
So strong execution on the new assets, especially Vizinjam, seems like it's quickly becoming a key piece.
Definitely proving its strategic value.
Okay, that covers the strengths. But the earnings call also mentioned some volume fluctuations, specifically at Mundra and Dhamra, two major ports. What happened there?
Right, good pickup. Mundra's volume dip was linked to two main things. First, some geopolitical issues caused a temporary blackout, apparently.
Okay.
Second, disruptions to shipping routes related to a neighboring country and something called Operation Cinder, basically a naval operation that rerouted ships for a bit.
Ah, so external factors.
Yeah.
But is it recovering?
Yes. Management said container volume in Mundra bounced back strongly in July, up
Hmm.
10% from June, so seems temporary.
And Omra.
Damra saw a drop in iron ore traffic. That reflects a broader softness in the commodity markets internationally. But, interestingly, that was offset by higher coal volumes.
So shifting commodity flows.
Exactly. And it actually led them to invest in new berths specifically for coal at Damra. So they're adapting. The key takeaway for you here is how these external factors can hit specific ports, but their diversified network helps absorb these shocks and maintain overall growth.
Shows a value of diversification. Okay, let's switch back to that logistics segment you mentioned earlier, the one with the doubled revenue, this shore-to-door revolution.
Yeah.
What's driving that incredible growth, and what's the strategy?
Well, the revenue jump to fiscal 169 crore was mainly driven by trucking and their international freight network services. They really emphasize this integrated model.
Using both physical assets and, like, tech platforms.
Precisely. Hard infrastructure like warehouses, plus soft infrastructure, their tech. And it's not just revenue. Their EBITDA margins in the other logistics businesses actually improved from 27% up to nearly 30%. Shows better efficiency.
Interesting.
And what's really clever is how they position trucking and the freight network services. They call them high ROCE, return on capital employed businesses.
Hmm?
Why? Because they don't need much new capital expenditure.
Asset light, in a way.
Kind of. They leverage existing infrastructure and technology. So even if the EBITDA margins are slightly lower than, say, core port operations, they significantly boost the overall company ROCE because the capital investment is minimal.
Smart capital allocation. They also mentioned innovation and people, didn't they? How does that fit in?
Yes, they credit their tech platform heavily. Built in-house, they said, by young data scientists using AI. That's what enables the efficient coordination of multimodal transport. Basically, helps them sweat the assets better.
Using tech to maximize what they have.
Exactly. And on the people side, they highlighted their focus on training, providing good accommodation, respecting quality of life for the workforce. That's crucial for running a complex, people-intensive logistics operation smoothly.
Makes sense. So what's the future plan for logistics? How big can this get?
They have ambitious targets, aiming for 35–40% ROCE for the logistics business within 3–4 years. They're building a kind of hybrid model, some asset-heavy parts, some asset-light to balance returns.
And the ultimate goal?
The why is to transform APSEZ, move beyond being just a port operator to becoming this end-to-end transport utility, managing the whole supply chain, basically from the ship site, the waterfront, right to the customer's gate.
A fundamental shift in their identity and market position, capturing value all along the chain.
That's the idea. It puts them in a different competitive space, moving beyond just ports into that broader logistics arena.
A very significant strategic move. Okay, let's touch on the marine segment too. That also saw huge growth, nearly tripled revenue. What fueled that?
All right, marine revenue shot up 2.9 times to 541 crore. A big part of that was the Astro acquisition they made, plus buying new vessels. Their fleet's now at an all-time high, 118 vessels.
Wow, quite a fleet.
And profitability jumped too. Marine EBITDA margin went from 40% last year to 55% this quarter.
That's a big improvement. What's the strategic focus there?
They're concentrating on the MESA region, Middle East, Africa, South Asia, serving top-tier customers, often with existing medium to long-term contracts already in place.
Locking in revenue.
Exactly. It ensures high returns on the capital they deploy in that segment. It's another example of diversifying with high-margin, capital-efficient businesses alongside the core ports.
So we're seeing impressive growth, strategic diversification into logistics and marine. The big question then is, how are they managing the finances? Funding all this expansion while keeping things disciplined.
That's a key point, and they seem quite focused on it. They maintained a net debt to EBITDA ratio of 1.x.
Which is pretty healthy, right?
Yeah, generally considered quite manageable, especially given the growth investments. They also managed to extend their average debt maturity, push it out from 4.3 years to 5.2 years. Gives them more breathing room.
How do they do that?
Through some smart financial moves, they issued 5,000 crore in long-term, 15-year bonds, non-convertible debentures to LIC, and they did a tender offer to buy back some of their outstanding US dollar bonds early.
Okay, refinancing and extending duration.
Right. And they managed to reduce the interest rates, the yields, on their bonds by up to 116 basis points through these actions. That tender offer for the USD bonds had already received about US $384 million in tenders by late July. Shows proactive debt management.
It definitely sounds like they're keeping a tight grip on the balance sheet. So looking ahead, where are they putting their money? What are the capital allocation priorities?
They laid out several key areas. For the ports, it's continued investment in container capacity. Mundra, Hazira, Gangavaram, Vizhinjam, expanding container handling capabilities.
Makes sense with making India and growing containerization.
Absolutely. It aligns directly with those trends. They're also investing in what they call RSR, sea rail infrastructure.
RSR.
Yeah, especially at ports like Dhamra, Gangavaram, Karaikal. The idea is to better handle the shift from imported coal towards coastal coal movement within India, building the infrastructure to move it efficiently by rail and sea.
Adapting to changing energy logistics.
Right. Plus, they're expanding tank farm capacity for chemicals at Hazira and building a whole new ecosystem for chemical industries around Dhamra.
So building integrated industrial zones around the ports, too.
That seems to be the plan. And of course, continued investment in those technology platforms we talked about to maximize efficiency across the whole chain.
What about land and international acquisitions?
They're strategically buying land for future logistics parks, particularly near growth hubs like Vizhinjam, anticipating its role as a gateway. Internationally, the focus is clearly on brownfield acquisitions.
Buying existing assets, not building from scratch.
Mostly, yes.
Yeah.
Or zero capex deals where possible. They want assets that offer strong, immediate revenue and EBITDA. Like that NQXT port acquisition in Australia, they got approved.
Right, the multi-user export terminal.
Exactly. 50 million tons per annum capacity, existing operations. That fits the bill perfectly. Greenfield projects, building new ports internationally, that's a much lower priority because the payback time is so much longer.
Makes sense from a capital return perspective. What about their overall long-term cargo targets? Still aiming for that big number?
Yes. They reiterated the target of handling 1 billion metric tons of cargo by 2030, with about 150 million tons of that coming from international operations. Though they did hint they might actually exceed that international target.
Ambitious.
Very. And they acknowledged that for India to reach its national target, 10 billion tons of port capacity by 2047, massive greenfield projects will be needed. They mentioned Wadwan specifically, which they're studying, called it potentially a next-level port for India.
So, keeping an eye on future mega projects, too. Okay, beyond the financials and strategy, how is APAC performing on ESG? Sustainability, corporate governance, are they making progress there?
Yes, they highlighted quite a few points on ESG. They got recognized as a leader by the Carbon Disclosure Project, CDP, for supplier engagement. They maintain their prime status in the ISS ESG rating.
Good ratings, then.
Yep, and they're included in ESG indices like the Nifty 100 ESG sector leaders. CRISIL also gave them a strong ESG rating. A tangible achievement they mentioned was getting 12 of their ports certified as zero waste to landfill.
That's significant. Any specific environmental projects?
They mentioned Hazira Port, building India's first road using steel slag and industrial byproduct within the port, and deploying electric-powered cranes at the Netaji Supais dock in Kolkata, moving away from fossil fuels. Small steps, but showing intent.
Okay, so environmental efforts are visible. What about the S&G social and governance? Any updates on skill building or board structure?
On the social side, they've started skill-building centers at Mundra and Krishnapatnam. The idea is to train local youth with skills relevant to port and logistics operations, creating a skilled workforce they can potentially hire.
Okay. And governance.
A key change there. The board approved the redesignation of Mr. Gautam Adani from executive chairman to non-executive chairman, effective from August 5th, 2025.
Stepping back from the day-to-day executive role.
Seems to be the signal, yeah. A move often seen as enhancing corporate governance structure. They also appointed Mr. Manish Kejriwal as an additional director, non-executive, and independent.
Right. Now, we should probably touch on this. The company has faced scrutiny, past allegations from a short seller, and that U.S. DOJ thing involving an executive director, though not the company itself. Did management address this?
They did address it briefly on the call. They essentially stated that those prior allegations, where the company itself wasn't named in the indictment, have not had a material impact on their financial results. And they reaffirmed their compliance with all applicable laws and regulations. Their main message seemed to be focusing on the strong operational performance and strategic execution, which the Q1 numbers largely support.
Understood. So wrapping this up then, today you've really seen how APS-EZ is shifting gears, right? Transforming from just ports into this broader integrated transport utility.
Absolutely, expanding significantly into logistics and marine services while keeping a close eye on the finances and increasingly on sustainability too.
It really isn't just about counting cargo containers anymore. It feels like they're building this whole ecosystem, connecting the ship all the way to the customer's door.
Capturing value at every step, that's the goal.
So here's something to think about. As APSEZ keeps weaving together ports, logistics, marine, could this integrated model actually set a new global benchmark for how supply chains operate? And if it does, what kinds of new opportunities or maybe even challenges could that create for the future of trade as we know it?